Are we currently in a situation that's similar to the 2000s and names went up like crazy, and then with a big bust the markets collapsed? And we have a situation now that yesterday after the Tesla earnings the stock was down around 12%, and that is not only significant to the EV industry but also overall for the markets, I think. And it's kind of reminding me a little bit of some of the things that happened in the 2000s. And I don't want to make a doomsday video here. I'm not calling for a huge crash or something like that. However, already yesterday I pointed out this chart, which was about the relationship between Chinese equities and US equities, here taking the QQQ versus CQQQ and seeing that they have been range bound for years and have been trading in a kind of stable relationship, sometimes US outperforming, sometimes China outperforming. But since the Fed started raising rates, we've seen this huge outperformance by US stocks versus Chinese stocks. And to me, that's what I said yesterday, this kind of seems a little bit bubbly. And this is not just the case if we look Chinese stocks versus US stocks and the US outperforming, but actually it's the US versus the rest of the world. So basically the US is eating up the world in terms of stock market capitalization here. So this is the QQQ versus SPDW, and that is the world of the developed world, actually ex-US, an ETF for that. And if you look at this chart, you see something quite similar to the outperformance of the US versus China, which is the US outperformance here versus everybody else, the rest of the world, even the developed markets, including Germany, Japan, France, and whoever. Now, if we look in what's driving this performance, it's basically the US mega caps like Apple, Microsoft, Alphabet, Amazon. And since yesterday, Tesla is really not part of this anymore. It actually even fell out of the top 10 holdings of US public companies. So this means if your portfolio was made up of those magnificent seven like Apple, Amazon, Nvidia, Tesla, Meta, Microsoft, and Alphabet, Google, you will have a great performance in your portfolio. But if you even invested in some smaller caps, even in the US or any other part in the world, or of course China, then your stock market performance would be very, very weak. And I have a video here of a webinar with Brendan Ahern by GrainShares, which I had previously here on the channel, in which he goes more into depth how this compares between US and China, and also how this is reminding him of what happened in the 2000s.
One of our core thesis that historically we've spoken to investor that's articulated in our 2024 Outlook piece, which is now available on craneshares.com, has been this significant outperformance of U.S. equities versus not just China and emerging markets, but really non-U.S. equities that since the global financial crisis low through today, or through yesterday's close, the S&P 500 is up 835%, and yet Chinese equities, as defined by the MSCI China, are barely over 100%. But this underperformance is not driven not unique to China. MSCI emerging markets is not even up 200%. And in fact, all country world ex-US, so all stocks minus US stocks, is not even up 1/3 of US stocks. And it's interesting that we see an element of investor trepidation around China, and you've actually seen the growth of EM ex-China strategies, but in fact, MSCI emerging markets Latin America has performed almost as poorly as not just China, but emerging markets and non-US stocks, and yet you don't hear about EMX Latin America strategies, do you? And I think the culmination of 14 years, 56 quarters of client calls, board meetings, trustee meetings is investors are grossly underweight non-US EM and China, and the most crowded trade globally is US stocks. And again, on craneshares.com, we articulate this thesis in our 2024 Outlook. And the last gasp of this U.S. equity outperformance has been under the narrative of AI investing. We see this renewed Magnificent Seven U.S. tech equity outperformance at the expense of basically all other stocks globally. And we just don't see how this is sustainable, particularly looking back over the last 14 years. And a contributor to this outperformance on the next slide is that in order to keep up, active managers, global equities have moved so many of their assets into these top 7 stocks that, utilizing our friend Stephen Holden of Copley Fund Research, he's proven this by looking at the underlying positions of these actively managed funds. In order to survive, these managers are buying these small subset of securities across the thousands of securities across the globe. They're all piled in overweight in this small subset of securities. And from our travels of engaging with many investors across the globe that utilize our exchange traded funds, we just cannot remarkably find how many of them are overweight U.S. equities. But some element of that is out of self-preservation, that there's only one asset class, one subset of an asset class that's working, and that's this small number of U.S. tech plays. And I think on the next slide, if we step back, that unfortunately as we age, we can say that reminds me of something. And I can't help not remember in 1999, we had a very, very similar situation where a very small subset of, again, U.S. tech stocks were the only thing that was working globally. And investors all piled into these names at what turned out to actually be at the exact worst time. And in fact, if you look at what happened following that small subset of securities, it turned out it was that concentration of this small number of stocks representing such a disproportionate percentage turned out to be the proverbial canary in the coal mine. And I think we've seen this. The financial sector became 25% of the S&P 500 right before the financial crisis. And we're seeing that situation again play out. But we have to understand that why is all of this money coming out of non-US, out of EM, out of China, into this small subset of US? It's an AI craze, or is it just the survivorship, the necessity to own the only thing that's working?
And so Brandon has a point here. This is a very crowded trade in the US. And also, if we look at the top 7 stocks into 2000s, these have been Microsoft, Cisco, ExxonMobil, GE, Intel, Apple, and Nvidia. Also those large caps. And that's, of course, besides all of the unprofitable tech, which was the bubble in the first place. But in the end, this resulted in this huge correction in the market in the 2000s, which has been famous. And I'm now just wondering, given those extremes showing up again, whether or not we might be in the same situation as of now. And that's also coming back to our Chinese stocks. What I'm currently lacking or seeing as is lacking here in the market is some sort of a breadth, which means that not only 7 stocks are actually performing well, but that we get less of such kind of signals here where we see that the valuations in one part of the world are totally depressed, almost not making any sense based on fundamentals anymore, whereas another part of the world is just outperforming everything. In fact, just 7 names, carrying all of this in a very, very crowded trade. And now the big question is now what's happening next. Now we've seen that Tesla has been shot. Well, maybe that's something to say here about the EV industry or Tesla's problems in specific. But as I said before, I don't want to make a doomsday video about it. I don't think Tesla is over. I don't think the stock markets are hopefully over. We'll hopefully see that everything's working out in the end. What could be a way for this to unravel as well is that even S&P 500 could still continue to perform well, even maybe, of course, a little correction here and there in between. But what I would like to see is actually that the breadth is picking up again, that fund managers are taking on some sort of risk again. Smaller caps, risk names, including China and including tech names that have been sold off up to 90% wherever they are. And so I hope that this might be the next stage for the markets overall, because otherwise we might be indeed in this situation that we'll see those 7 stocks, one after another, getting shot, getting down, and then ultimately the S&P 500 will also go into a huge correction, and that would be an issue on a global stage that would have economic consequences and possibly even consequences, for example, on a political level. And of course, we've got important elections coming up, right? So what is your take? Are we in the situation that we are unwinding a bubble here and Tesla was just making the start with, or are you trying to be as optimistic as I am currently, and you think the next step will be for fund managers to, have a little bit more market breadth, taking on more risk again, and we'll see actually that overall stock markets are going to perform well in the future. Thanks for watching. I'm curious to read your comments. Have a great weekend and see you in the next one.